In today's lesson, we're going to be covering liquidity. If you're relatively new to the concept of what liquidity is, here's a quick overview of what we mean by liquidity. Now, what I want you to do, I want you to think of liquidity as how many buyers and sellers are present within a market and whether transactions can take place easily. So, for example, if there is 10 people buying at £1, there needs to be 10 people selling for £1 for it to be a perfectly liquid market. So if there was only 7 people selling for £1 but 10 people buying, then some people's orders would not be getting filled. Now think of this on a much larger scale. There is on average $6.6 trillion traded daily in the forex market. So in order for banks, hedge funds and other financial institutions to trade the large volumes they do each day, they need to manipulate the markets by creating liquidity. And the way they do this is by opening lots of buy and sell orders and moving price to create patterns and trends. And this then induces traders like us retail traders or even other institutions to get into the markets. So to shorten that even further, when we are looking at patterns on the charts, liquidity points, we are essentially looking at areas where it's very likely there's going to be other traders in the markets on the opposing side where their stop losses are either going to be triggered or even their take profits. Now, liquidity is not just about taking people's stop losses. For example, if your take profit is at a structural high, but somebody is selling at that structural high, they need to buy your position in order for you to take your profit and for them to get into that trade. So liquidity is not always about taking other people's stop losses. It is also about facilitating those transactions on both sides. So for the DRS strategy, there's a few types of liquidity we will be looking at. Now, first off, what we can see in this chart example is the session liquidity. Now, these grey boxes that you can see hovering around the candles are the trading sessions that we are focused on. So we have this session here. Okay, so we've got this broad grey box that is wrapped around these candles. Now, this is the Asia session. So that's from 10 o'clock at night, UK time, and we have this up until 7 o'clock in the morning. And the reason we have this up till 7 o'clock in the morning is this is where Frankfurt then opens and most of the volume from the Asia session has then died out. 8 o'clock in the morning, which is here, this is where the London session has then opened, and we are looking at this zone up until 1 o'clock in the afternoon, UK time, as this is when New York opens, and we would then be looking at a fresh influx of trading volume. So why are we looking at sessions as liquidity? Now, for example, in this situation, what we can see here is the high of the Asia session. So this is the highest point that this Asia session had peaked at during the time that it was open. We can see that London has then opened, it's pushed to the downside, it's then failed to take this low. We've then seen price pushing impulsively to the upside, and then we've seen this wick, and we'll talk about wicks a little bit further on in the liquidity video. But after this wick has happened, this has grabbed some liquidity from this structural high and from this session high, and as you can see, price has then continued pushing back to the downside, ultimately taking the Asia low. Another form of liquidity we will also be looking at and utilizing is the daily, weekly, monthly highs and lows. So in this chart, we can see this blue dotted line at the bottom and the blue dotted line at the top. This represents the high of the day and the low of the day. So we have our Asia session here, we have the London, or we have part of the London session here, and then we have the overlap of New York. And this is the entire trading day for up until this point. And this point here. So in here, this is the high and low of the markets for that trading day. And then what we're looking at here is when the following day opens, we've had a high impact news. In this situation, this was for the euro. But what we can see the news has done, it has swept the previous day's low. And after it swept the previous day's low, we then had an impulsive push to the upside. Now with the DRS, occasionally this can provide a trading setup, but ultimately what we're looking at here is the grab of liquidity from the previous day low. And after that liquidity grab, we've then seen that strong retracement back to where price has come from. Now, if you've watched the LSM content, you'll be quite familiar with this concept, and it is something that is used quite a lot within the LSM. But as you can see, it also then has its use with the DRS strategy. And the higher up the time frame this drawn liquidity is, i.e. whether it's a weekly high or low or even a monthly high or low, the more significant and stronger the reaction will be. However, we don't need to go up or down the time frames. We can still focus on just the 5-minute time frame with the DRS, because if this is the new trading month or even the new trading week, This still has the potential to be the weekly or monthly low, or this still has the potential to be the weekly or monthly high. Now, a sweep of the daily liquidity is more likely to happen more often than a weekly or monthly draw on liquidity, but it's still something to take into consideration. If we are looking for a sweep of liquidity, are we likely going to take a daily high, or are we just going to take a session high or low? And another form of liquidity we will also be looking at is structural liquidity. Now, in the previous video, we did speak about fair value gaps, and we actually used this particular trade example to explain fair value gaps. But one thing we can also see within this trade example, and this particular example is what I would consider a A+ setup for many reasons. Obviously, we spoke about the reasonings for the fair value gaps in the previous lesson, but also where we have the liquidity. We have a shift in market structure, a nice sweep of liquidity here, but we also have a structural swing low. Now, this swing low, what we can see is this is a liquidity point. It has imbalance above. It's also a POI that could be serving as a trap. Okay, and we have price pushing back to the downside, taking out this low. And as you can see, our target of 1 to 2 is then very easily met with very little stress or worry whether we're going to have a reaction from here or further down. Our target is met. The drawn liquidity is further below our target, and this entire push to the downside has come from a session liquidity sweep, a structural liquidity sweep, and the target is being attracted to this structural low, as you can see was then eventually taken. Now, when it comes to a wick, if you've been studying the content that I put out for the SMT, both in the LSM, the beginners content, and on Instagram, you may understand what my take is when it comes to wicks. Now, when it comes to a wick, this is usually a sign that there is lack of commitment for price to continue in that direction. So what we can see here, we have this trading window, the 3 till 4. We have a fair value gap. The rules are partially met within this trade setup, except we have this liquidity here. We have this structural low that has been taken. So if we were creating lower lows and lower highs, we would expect to see a pattern quite similar to this. All right. Now, what we've then seen is rather than a nice strong candle close below this low, like what we've seen here, and like what we've seen with this low here, we've essentially got a strong wick, price pulling away from this area. Now, if we was going to take this trade and disregard what's happening around this wick, as you can see, the trade would have hit stop loss. And ultimately from here, the momentum leaving the market has just shown that prices then just continue going sideways for the rest of the evening. Now, what we want to be aware of is if we are looking to take a trade similar to this, and we see a strong wick going against the narrative after it's taken maybe some liquidity from somewhere like this, then this is a good indication that we do not want to be in a trade around this area, because that liquidity grab or that wick is likely going to fuel a further push to the upside and take out our stop losses, or even the momentum is then going to die out like we can see in this situation just here. So just to recap what we've covered in this lesson, we have looked at session liquidity, daily, weekly, monthly highs and lows, structure and wicks. So what I would encourage you to do now is have a look at your charts, backtest what you see, look at the rule set from the DRS framework, and use this to start looking at potential trade setups that could have happened in the past, and start looking at this within your forward testing as well. Now, if you have any questions regarding the liquidity, then as usual, please feel free to reach out. But until then, see you in the next video.